Welcome back to the deep dive. I'm so glad you could join us today.
It is great to be here.
I am looking right at you, the learner. Yes, you.
Absolutely.
Whether you are, frantically prepping for a high-stakes board meeting or trying to catch up on the latest tectonic shifts in financial reporting standards.
Or maybe you're just insanely curious about how massive global companies actually account for billions in assets.
Exactly. And I do mean billions of dollars. This deep dive is custom-tailored exactly for you.
And I think tectonic shift is really the perfect way to describe what we are going to be looking at today.
Yeah, I have to confess something right out of the gate here. When I first looked at the stack of sources for today's deep dive, I felt a slight wave of panic, honestly.
I can completely understand that.
We are looking at a very dense, very intimidating stack of financial reporting guidelines. Specifically, Indian Accounting Standard 116.
Right, Ind AS 116.
Yeah, you'll hear it referred to as Ind AS 116, and it is entirely focused on leases.
It certainly presents as an impenetrable wall of text at first glance. The language is highly technical, and the underlying concepts challenge a lot of traditional assumptions.
About what it actually means to own or owe something.
Precisely.
Right. It looks like pure math and regulatory jargon at first. But we are going to break it down. Okay, let's unpack this.
Let's do it.
Our mission for this deep dive is actually very simple, even if the material is complex. We're going to demystify the absolute most complex areas of Ind AS 116.
We are not just going to skim the surface here.
No, we are going to navigate three specific financial labyrinths that give even seasoned accountants and CFOs a headache.
Those three labyrinths represent the core mechanics of how modern businesses report their operations to the world.
Because before this standard, companies could hide massive liabilities from
Oh, absolutely. Things like long-term building leases or fleets of aircraft completely off their balance sheets. And AS 116 was designed to drag all of those invisible obligations into the light.
Which means the numbers we are talking about today aren't just bookkeeping adjustments. They fundamentally alter how a company is valued by the market.
Well, they do.
So, here is the roadmap for what we are doing today. First, we are looking at modifications.
The rules for changing a contract midstream.
Right. We are going to decipher when a change to a lease contract is considered a completely new separate lease versus just a remeasurement of an existing one.
We'll be looking closely at the principles outlined in illustrations 33, 35, and 37 for that.
Yeah, and we're going to uncover the logic behind a decrease in scope, which has some wild implications for a company's profit and loss statement.
That section alone fundamentally changes the strategy of corporate real estate negotiations.
Second, we're diving into subleases. This is a topic that can feel a bit like a hall of mirrors.
It really can.
We're exploring the world of intermediate lessors and why something called the right-of-use asset, or ROU asset, is the absolute star of the show.
Rather than the physical building itself, which we'll see clearly when we get into illustrations 39 through 41.
Exactly. And third, we are looking at transitions. We will look at the massive, painful shift from the old standard to Ind AS 116.
Specifically focusing on the modified retrospective approach.
And this incredible accounting maneuver it performs on a company's opening retained earnings. We'll use illustration 43 to anchor that.
As we get into this, I want you to visualize something for a second. Imagine a cityscape.
Okay, a cityscape.
Skyscrapers, sprawling retail parks, massive logistics warehouses. Now, imagine all of those physical buildings dissolving and transforming into lines on a giant floating balance sheet.
That is a wild image.
What's fascinating here is that while the standard sounds like it is just about pure numbers, it is actually about representing the true economic reality of a business.
Right, accounting isn't just math.
It is the language of business storytelling. And Ind AS 116 fundamentally changed how that story is told to investors, creditors, and the public.
I really like that visual. A cityscape turning into a balance sheet. It perfectly sets the stage for part one of our deep dive.
The crossroads of change.
Or, as the standard formally calls it, lease modifications. So let's start by defining the baseline. Outside of a vacuum, in the messy reality of corporate operations, what actually constitutes a modification to a lease?
Well, business is inherently dynamic. A 10-year lease signed in 2018 looked very different to a company by 2020 or 2022.
Yeah, no kidding.
A modification occurs anytime the scope of the lease changes or the consideration, meaning the price for the lease, changes.
But only in a way that wasn't originally baked into the initial terms, right?
Correct. It has to be a change that was not part of the original terms and conditions of the contract.
Let me make sure I have the boundaries of this right. Let's say a company signs a lease that says rent is $10,000 a month, but it will automatically increase by 5% every year.
Okay.
When year 2 hits and the rent goes up to $10,500, is that a modification?
It is not. That is simply the execution of the original contract. Both parties knew that escalation was coming.
Right.
A modification requires a renegotiation. It requires both the lessee and the lessor to come back to the table and agree to alter the fundamental boundaries of their relationship.
Okay, that makes sense. So we were talking about unscripted changes. Like a fast-growing tech firm realizes they're bursting at the seams, so they go to the landlord and say, we need the floor above us too.
Yes, that would be a modification.
Or a major retail chain realizes foot traffic is dying in a particular mall, so they negotiate to surrender half of their square footage.
Also a modification.
Or maybe a logistics company just wants to extend their warehouse lease for another 5 years beyond the original end date.
All of those scenarios require a structural change to the contract. Now, under the older standard, which was known as AS 19, the accounting for these midstream changes was relatively loose.
There wasn't a comprehensive framework for it.
No, not really. Companies often just adjusted their rent expense going forward and moved on.
Just a quick fix.
But Ind AS 116 recognizes that a modification changes the economic reality of the entire arrangement. The balance sheet needs to reflect that new reality the very moment the ink dries on the modified contract.
Our sources provide an incredibly detailed roadmap that companies have to follow the moment a lease is modified. It's essentially a massive decision tree.
That's a good way to look at it.
And the very first fork in the road is this big split. When you change a contract, is this modification a brand new separate lease, or is it just a tweak, a remeasurement of the old one?
Yes.
Walk us through this, because the standard relies on a very strict two-part test to make this determination.
It is a critical fork in the road because the accounting treatment diverges wildly depending on the answer. To be accounted for as a separate lease, the modification must meet two specific conditions.
And it must satisfy both of them simultaneously, right?
Exactly.
Yeah.
It is an A&D condition. Failing even one part of the test pushes you down a completely different accounting path.
Okay, so condition 1.
Condition 1 relates strictly to the scope of the lease. The modification must increase the scope by adding the right to use one or more underlying assets.
Let's ground this in a concrete example, similar to what we see in illustration 33. Let's imagine a fictional company. Let's call them Megamart. They are a massive grocery chain.
Okay, Megamart.
They currently rent a 50,000 square foot standalone building. Business is booming. They want to add a massive bakery and deli section, so they negotiate with the landlord to also rent the empty 20,000 square foot building right next door.
Effectively expanding their footprint.
Right. Does that pass condition 1?
It does. Megamart is gaining the right to use an additional distinct underlying asset, the building next door, that they did not have access to under the original lease.
What if Megamart didn't want the building next door? What if they just went to the landlord and said, we originally signed a 10-year lease, but we love this location so much, we want to modify the contract right now to make it a 20-year lease?
Adding time instead of space.
Yeah. Does adding time count as adding scope?
It does not. Extending the timeline of your current lease is a change in the lease term, but it does not add the right to use another underlying asset.
Because you are still just using the same 50,000 square foot building.
Exactly. Therefore, extending the term fails condition 1 immediately. Condition 1 is rigidly focused on the addition of new, distinct physical or contractual space.
Okay, so Megamart renting the building next door passes condition 1. They've increased the scope. What is the hurdle for condition 2?
Condition 2 shifts the focus entirely to the economics of the deal. The standard asks, is the price of this additional right of use commensurate with its standalone price?
I need you to translate commensurate with its standalone price for me.
It means we have to look at what Megamart is paying for that new 20,000 square foot building next door. Are they paying the fair market rate?
The street price.
Yes. If a completely random business, a hardware store, for example, walked off the street and wanted to rent that exact same building, what would the landlord charge them? If the landlord would charge the hardware store $20,000 a month, and they are charging Megamart $20,000 a month, then the price is commensurate.
Megamart isn't getting a special deal just because they already rent the building next door.
Correct.
Okay, let me stop you there because that assumes a perfect, frictionless world. In reality, landlords give discounts to existing tenants all the time.
They certainly do.
If Megamart is a reliable tenant, they always pay on time, and they're taking more space, the landlord saves a ton of money on broker fees and marketing.
That's true.
So the landlord says, look, market rate is $20,000, but for you, Megamart, I will lease the building next door for $15,000. Under this rule, because they got a 25% discount, they fail the test.
They do fail the test.
Isn't that just punishing good business relationships?
It is not about punishing the company. It is about accurately mapping the economics. Think about why Megamart got that discount.
Because they were already there.
Exactly. They didn't get it in a vacuum. They got it because of the leverage provided by their original 50,000 square foot lease.
Ah, I see.
If we connect this to the bigger picture, the standard argues that if the price isn't the standalone market rate, then this new lease is economically subsidized by and intertwined with the original lease.
You cannot treat them as completely separate independent transactions because the pricing proves they're linked.
That is the exact logic of the standard.
That is a fascinating way to look at it. The discount acts as the glue that binds the two contracts together in the eyes of the accountants.
Yes.
So let's play out the scenario where they do pass both tests. Let's say Megamart takes the building next door, and they pay the full $20,000 market rate.
They pass condition 1 with more space and condition 2 with the standalone price.
What does the accounting team actually do?
This is the easiest scenario for the accounting team. Because the modification meets both conditions, it is treated purely as a separate lease.
So the old lease is fine.
The beauty of this is that the old lease for the original building continues entirely untouched. You don't have to recalculate anything.
Nice.
The new lease for the building next door is set up as a brand new right-of-use asset and a brand new lease liability on its own commencement date, using the discount rates applicable on that specific day. It is a clean break.
Which is great, but as we discussed, companies rarely pay full retail if they don't have to. So let's go down the far more common path, which is detailed in illustration 35.
The remeasurement path.
Megamart takes the new building, but they negotiate that sweet $15,000 discounted rent. They pass condition 1, but they fail condition 2. What happens now?
Since it is not a separate lease, the accounting team has a much heavier lift. The new space is economically tied to the old space, so the company essentially has to mash the two contracts together and reevaluate their entire position with this landlord.
Mash them together.
The lessee must reallocate the total consideration in the modified contract. More importantly, they have to remeasure their total lease liability at the exact date both parties agreed to the modification.
Okay, let's unpack this. Remeasuring the lease liability. I want to make sure you, the learner, really grasp the mechanics of this. The lease liability is essentially a massive debt sitting on the balance sheet, right?
Yes.
It represents the present value of all the future rent checks the company is legally obligated to write.
That is a very accurate way to conceptualize it. It is the company saying, over the next 10 years, we owe a total of $10 million in rent. But because of the time value of money, that $10 million in the future is worth slightly less today.
So they discount those future payments back to today's dollars to get the present value.
That is the lease liability.
And when a modification happens that is not a separate lease, the accounting team has to throw out the old liability number and calculate a brand new one.
They do.
They look at all the remaining rent payments for the original building, plus all the new rent payments for the new building, and discount them all back. But here is the tricky part I saw in the sources. They can't use the discount rate they used back when they signed the original lease, can they?
They cannot. And this is a major point of friction for companies. When you remeasure the liability, you must use a revised discount rate.
Which is usually what?
Typically, the lessee's incremental borrowing rate determined at the effective date of the modification.
Why does that matter so much? Why does the standard force them to update the interest rate?
Because the macroeconomic environment changes and the company's own risk profile changes.
Right.
Let's say Megamart signed the original lease 5 years ago when interest rates were at rock bottom, say 3%.
Right.
But today, when they modify the lease, global interest rates have spiked, and Megamart's borrowing rate is now 7%.
A huge difference.
If they use the old 3% rate to value this new combined obligation, they are misrepresenting the current economic reality of what it costs them to finance their operations today.
So the modification forces them to update their assumptions to current market realities. They calculate this new, massive present value using the new 7% rate.
Correct.
Their total lease liability just went up significantly because they took on more space.
Yeah.
In accounting, every action has an equal and opposite reaction. The balance sheet has to balance.
Always.
If the debt side goes up, What goes up on the asset side to offset it?
To balance the equation, the company makes a corresponding adjustment to the right-of-use asset, the ROU asset. They simply increase the carrying amount of the asset on their balance sheet to match the increased liability.
Okay, so in a scenario where you add space but get a discount, it's a lot of math, you have to update your interest rates, but ultimately it's just a balance sheet adjustment.
Exactly.
Your liability gets bigger, your asset gets bigger, but the whole thing stays in relative harmony.
In that specific scenario, yes. The friction is mostly administrative for the accounting department.
But here's where it gets really interesting. And frankly, this is the part of the sources, specifically around illustration 37, that made me realize how dangerous lease accounting can be for a company's perceived performance.
The decrease in scope.
Yes. I want to pivot to the decrease in scope logic.
This is where the accounting gets incredibly nuanced, highly consequential, and where investors or anyone sitting in a board meeting really needs to pay strict attention.
Let's set the scene with a new hypothetical company. Let's call them Aerotech. They are an aerospace parts manufacturer.
Okay.
5 years ago, they leased a massive 100,000 square foot testing facility. The lease was for 10 years. But the industry hits a downturn. Aerotech loses a major government contract, and they realize they are bleeding cash paying for half an empty building.
A very common real-world problem.
So they go to the landlord and negotiate a modification. They are going to surrender 50,000 square feet and hand the keys back for that half of the building. They are decreasing the scope of the lease. Why is this the trickiest part of the modification standard?
It is complex because, unlike adding space where you are just expanding the pie, surrendering space means you are legally and economically terminating a portion of the contract.
You are extinguishing a right you previously held.
Exactly, a partial termination.
Okay, so common sense would dictate that if Aerotech is giving back exactly 50% of the building, they just pull up their balance sheet, look at their lease liability, cut it exactly in half, look at their ROU asset, cut it exactly in half, and call it a day.
That sounds reasonable.
Right. Why wouldn't that work?
If only accounting were that simple. That approach assumes that the asset and the liability decrease at the exact same speed over the life of the lease.
But they don't.
They do not. The mechanical ways these two figures are amortized over time are fundamentally different.
I need you to break that down for me. Explain how the asset degrades versus how the liability degrades.
Let's start with the right-of-use asset. The ROU asset is typically depreciated on a straight-line basis.
Streamline basis.
This means it loses its value evenly in equal chunks every single year over the life of the lease. If it is a 10-year lease, the asset loses exactly 10% of its value every year.
So by year 5, it's down by half.
Yes. By year 5, the asset has depreciated by exactly 50%. It is a perfectly straight, predictable line downward.
Like a car losing value steadily every year. Got it.
Yeah.
What about the liability? Why doesn't the debt go down in a straight line?
Because the lease liability is a financial debt and it behaves like a mortgage. It is reduced using the effective interest method.
Oh, right. Anyone who's ever looked at a mortgage amortization schedule knows how painful this is.
Exactly the same principle. In the early years of the lease, a huge portion of your monthly rent payment goes simply toward paying off the accrued interest on that massive total liability.
Very little of your payment actually chips away at the principal debt.
Right. As the years go on, the principal slowly shrinks, the interest burden shrinks, and more of your payment goes toward the principal.
So it's a curve, not a straight line. The debt goes down very slowly at first and then much faster at the end.
Yes. So let's look at Aerotech at year 5. They are halfway through the lease. Their ROU asset, depreciating on that straight line, might be sitting at exactly 50% of its original value.
Okay.
But their liability, because they were mostly paying interest in those early years, might only be paid down by 40%. The liability is still sitting at 60% of its original value.
Okay, I see the trap forming.
So Aerotech signs the modification to surrender half the space. The standard says they must decrease the carrying amount of the ROU asset to reflect the partial termination.
They gave back 50% of the space, so they reduced the remaining ROU asset by 50%.
Correct. But they also have to recalculate the liability based on the new reduced rent payments for the remaining space.
And because of that mortgage-style curve, the reduction in the liability is not going to perfectly match the reduction in the asset.
Rarely, if ever, will they match. You reduce the asset to reflect the physical termination, and you recalculate the liability based on the new cash flows using a revised discount rate.
And you are going to be left with the difference.
A gap between the amount the asset decreased and the amount the liability decreased.
And as we established, the balance sheet demands equilibrium. You can't just have a gap floating out there in the ether. If the asset side and the liability side no longer match, where does the ghost money go?
That difference is immediately recognized in the profit and loss statement, the P&L, as a gain or a loss on the termination of the lease.
So what does this all mean for the executive team or the investors? Let's play this out. Aerotech is downsizing because they're losing money, they're trying to be responsible and cut costs.
Yes.
But because of this accounting mechanic, if the reduction in their liability happens to be smaller than the reduction in their asset, they have to record a loss on the P&L.
They do.
They could literally report a terrible quarter to Wall Street because they tried to save money on rent.
That is an entirely plausible reality. The mechanics of the standard dictate that the termination of an economic right forces a reconciliation of the carrying values, and any discrepancy hits current earnings.
Wow.
It forces the company to immediately recognize the financial friction of unwinding a long-term commitment.
And the reverse is true as well, right? What if the math works out in the other direction? What if the liability reduction is massive compared to the asset reduction?
Then the company records a gain on the P&L. They artificially boost their net income for that specific quarter, entirely independent of their actual operational performance selling aerospace parts.
That seems incredibly dangerous for an investor who isn't paying close attention. A company could be bleeding cash operationally, but they negotiate to get out of a bunch of warehouse leases, record a massive phantom gain on their P&L, and suddenly their earnings per share look fantastic for the quarter.
Which is exactly why understanding Ind AS 116 is not just for accountants. If you are an analyst or if you are the learner sitting on a board, you cannot just look at the bottom line net income.
You have to read the footnotes.
You have to ask, did our profits spike this quarter because we sold more product or because we shrank our footprint and triggered a lease modification gain?
The standard forces transparency, but requires the reader of the financial statements to understand why the numbers are moving.
Exactly.
That is a brilliant takeaway. The key lesson from the crossroads of modifications is that scope decreases aren't just quiet bookkeeping updates hidden on the balance sheet. They have real, immediate teeth in the profit and loss statement.
They absolutely do.
Okay, let's shift gears. We have navigated the first labyrinth. Let's walk into the second one, Part 2, lease inception, the intermediate lessor, and subleases.
Subleases. This area of the standard often feels deeply counterintuitive at first glance.
Oh, for sure.
But it is where the concept of the ROU asset truly flexes its conceptual muscles.
To set the stage, let's use a narrative to explain the chain of custody here, drawing on the concepts from illustrations 39, 40, and 41. Let's imagine a company called CloudSync. They're a fast-growing software startup.
All right, CloudSync.
They lease 3 floors of a premium downtown office building from a massive commercial real estate conglomerate. The real estate conglomerate is the head lessor. CloudSync is the original lessee.
A very standard commercial arrangement. CloudSync brings the 3 floors onto their balance sheet as an ROU asset and records the lease liability for the rent they owe the conglomerate.
Right. But a year goes by, and CloudSync adopts a fully remote work policy. Suddenly, they only need 1 floor for executive meetings. They have 2 completely empty floors.
So they need a sublease.
Yeah, so they turn around and rent those 2 empty floors out to a local graphic design agency. The graphic design agency is the sublessee, and our software startup, CloudSync, is now caught in the middle.
They are paying rent to the big real estate conglomerate, but they are collecting rent from the design agency.
They have officially become an intermediate lessor.
A perfect setup. Now, under Ind AS 116, the moment CloudSync signs that agreement with the design agency, they have an accounting obligation. They, as the intermediate lessor, have to classify that sublease.
They have to determine if the lease they're granting to the design agency is an operating lease or a finance lease.
Yes.
Let me define those 2 terms quickly for the listener, just to ensure we are all on the same page. Historically, an operating lease is essentially just renting. You use the space, you pay a fee, you record it as an expense, but you don't claim to own the underlying asset in any meaningful economic way.
Correct.
A finance lease, however, means you have effectively transferred almost all the risks and rewards of ownership to the other party. It acts more like a financed purchase.
That is a solid working definition. And classifying a lease as one or the other dramatically changes how it is presented to investors.
This brings us to a critical, ironclad rule from the standard that companies constantly trip over. When CloudSync, our intermediate lessor, is trying to decide if this sublease is an operating or finance lease, the standard explicitly states they must make that classification based on the right-of-use asset they hold, not the physical underlying asset.
This is the crux of the issue.
So what does this all mean? Why does the standard care? A building is a building. Why can't CloudSync just look at the physical floors they are subleasing?
What's fascinating here is that the standard is forcing us to rigorously acknowledge what the intermediate lessor actually owns. And AS 116 strips away the illusion of physical property.
Because CloudSync doesn't own the building.
They do not own the concrete, the elevator shafts, or the HVAC system. If the building burns down, it's not CloudSync's asset that was destroyed, it's the head landlord's.
Right.
All CloudSync truly owns is a contractual right. A phantom, intangible asset, the right to use that specific volume of space for a strictly defined period of time.
The ROU asset.
Yes. The ROU asset is their only property in this transaction. So when they sublease the space to the design agency, they aren't leasing out a physical building. They are leasing out a slice of their intangible right-of-use asset.
Our sources provide a deep analysis of this dynamic, specifically in illustration 39. Let's walk through the logic of this because it highlights exactly why this rule is a trap for unwary accounting departments or CFOs who rely on old instincts.
Let's run the scenario. In this case, the physical downtown office building is a robust structure. It has an estimated economic life of 40 years.
Okay, 40 years.
CloudSync's original head lease with the conglomerate is for 5 years. After year 1, they decide to sublease the 2 extra floors to the design agency for the remaining 4 years of their term.
Okay, so if I am the CFO for CloudSync and I am relying on the old rules or just basic common sense, I look at the physical building. I'd say to my board, well, the building is going to stand for 40 years.
Right.
We are only subleasing it to this design agency for 4 years. 4 years is a tiny fraction of 40 years. It's barely 10%.
Which sounds like an operating lease.
Exactly. We are clearly not transferring the major part of the economic life of this building to the design agency. Therefore, this is a simple operating lease. We will just record the rent we collect from them as income every month.
And if you presented that logic to your auditor today, you would be forced to restate your financials. That is exactly the logic the old standards permitted, which allowed companies to keep massive financial shifts off their balance sheets.
Wow.
And AS 116 explicitly forbids looking at the 40-year building.
Because, again, CloudSync doesn't own a 40-year building.
They do not. Let's look at the underlying mechanics. CloudSync only possesses an asset that lasts for 5 years. Their 5-year right-of-use asset. That is the true, absolute economic reality of their position.
And after year 1,
by the time they sign the sublease, that asset only has 4 years of life remaining. So when they sublease the space for 4 years, they must compare that 4-year sublease term to the 4-year remaining life of their ROU asset.
And 4 years out of a 4-year remaining asset, that is 100%, that is the entirety of the economic life of their asset.
Exactly, the realization the standard demands. CloudSync is transferring virtually all of the remaining economic life and all the associated risks and rewards of their specific asset to the sublessee.
They're basically handing over everything they possess regarding those 2 floors.
Therefore, the intermediate lessor must classify this sublease as a finance lease.
That is a massive conceptual shift. And shifting from an operating lease to a finance lease isn't just a change in terminology. That completely rewires how CloudSync's balance sheet looks.
It does.
So let's walk through the exact accounting mechanics for the intermediate lessor once they realize they have a finance sublease on their hands. What are the steps CloudSync has to take to reflect this new reality?
The standard dictates a very specific 4-step process for a finance sublease, and it perfectly illustrates the incredibly awkward dual position of being an intermediate lessor.
Good one.
Step 1. CloudSync must derecognize or remove the ROU asset associated with those 2 floors from their balance sheet.
Makes sense. They essentially sold off that 4-year right to the design agency, so they can't claim they still hold the asset for their own use. It comes off the books.
Step 2. In place of that ROU asset, they recognize a new asset called a net investment in the sublease.
I need you to define net investment for me. What does that actually represent?
It is essentially a financial receivable. It represents the present value of all the future rent payments the design agency owes CloudSync over the next 4 years.
Oh, I see.
CloudSync has traded a right-to-use asset for a right-to-receive cash asset.
Okay, so the physical-ish asset goes off, a financial receivable comes on. What's step 3?
Step 3 involves our old friend, the profit and loss statement. Any difference between the carrying amount of the ROU asset they just removed in Step 1 and the net investment they just recognized in Step 2 goes directly into the P&L.
There it is again. The P&L acting as the great balancing mechanism for reality. Let's say Clydesync was paying $10,000 a month for those floors, but because downtown real estate got hot, they managed to sublease them to the design agency for $15,000 a month.
A good deal for them.
Right. So the present value of what they're receiving, the net investment, is higher than the value of the asset they gave up.
Oh,
So they record an immediate gain on the P&L.
they do. They recognize the economic profit of being a savvy middleman. Conversely, if the market tanked and they had to sublease it for $5,000 a month just to stop the bleeding, the net investment would be smaller than the ROU asset, and they would take an immediate loss on the P&L.
It's ruthless, but it's incredibly transparent.
Okay.
What is the final step?
Step 4 is the one that causes the most heartburn for executives. Clydesync must retain the original lease liability on their balance sheet.
Wait. Let me get this straight. They wipe the asset off their books, they hand the space over to the design agency, but they still have to show the massive debt to the original landlord on their own balance sheet.
That is correct.
Doesn't that make their balance sheet look significantly worse to investors? Their debt-to-asset ratio just got incredibly complicated.
It does make the balance sheet heavier, and executives often push back on this, arguing it feels like double counting. But the standard is unyielding because it reflects the true legal reality.
How so?
The original real estate conglomerate doesn't care that Clydesync subleased the space. Clydesync is still the entity legally on the hook for those remaining 4 years of lease payments.
So if the design agency goes bankrupt tomorrow and stops paying Clydesync, Clydesync still has to pay the conglomerate.
Precisely. The legal liability never transferred.
So the accounting accurately reflects their risk.
It removes the illusion that they have a physical asset they can use and replaces it with the reality that they have a financial receivable from a startup alongside an ironclad financial obligation to a massive landlord. It tells the exact, unvarnished pre-story of their legal and economic standing.
Okay, let's take a breath. Let's unpack this. We've conquered modifications, where we learn that scope decreases are a trap door that can drop you straight into a P&L loss due to the mismatched math of amortization versus interest.
Yeah.
We've conquered subleases, where we learned you can only lease out what you actually own, which is the contractual ROU asset, and that being a middleman forces you to hold the debt even after you give up the space.
Exactly.
Now, it is time for Part 3, time travel, or, as the regulatory bodies prefer to call it, transitions and opening retained earnings.
Time travel is a very apt, if slightly dramatic, way to think about transitions in accounting standards.
Let's set the historical context for the listener. An AS 116 wasn't handed down on stone tablets at the dawn of commerce. For decades, companies reported under the much looser AS 19 standard.
Yes, the old rules.
Under AS 19, operating leases were generally just kept off the balance sheet entirely. Companies just recorded the rent expense each year. Then, the regulatory bodies decreed that everyone had to switch to this new, incredibly stringent standard, Ind AS 116, which forces almost all leases onto the balance sheet.
A massive undertaking.
What is the fundamental operational challenge of first-time adoption for a massive corporation?
The challenge is scale and continuity. Changing a foundational accounting standard across a massive multinational corporation is akin to changing the engine of an airplane while it is in mid-flight.
That sounds terrifying.
It is for the accounting teams. You have decades of historical data, you have multi-year comparative financial statements that analysts and investors rely on to spot trends, and suddenly the very rules for how you measure and present your biggest assets and liabilities change overnight.
Right.
Companies need a way to transition their reporting without causing a complete rupture in their historical narrative.
And the standard, recognizing this nightmare scenario, provides a couple of different methodologies to make the jump. The first is called the full retrospective approach. What does that entail?
The full retrospective approach is the purest form of transition. It means a company must go back in time and restate all of their comparative past financial statements as if Ind AS 116 had always existed from the very beginning of every single lease they hold.
Wow. Let's imagine a company like Legacy Corp. They are a 100-year-old manufacturing firm. They have 5,000 leased facilities globally, warehouses, offices, motor pools.
Okay.
If they're presenting 3 years of comparative financial statements in their annual report, they have to go back to 3 years ago, find every single lease contract, recalculate the ROU asset and the lease liability from the very commencement date of each lease, even if the lease started 20 years ago, and rewrite their entire financial history.
That is exactly what it requires. It is theoretically perfect because it provides investors with a perfectly clean, comparable trend line.
But practically,
Practically, it is an absolute nightmare. Imagine trying to find the original paperwork for a warehouse lease signed in 1998. Imagine trying to determine what Legacy Corp's incremental borrowing rate was in a specific country 15 years ago to properly discount the liability.
that sounds impossible.
The data collection alone could take years and cost millions of dollars in audit fees. For many older, complex companies, the full retrospective approach is practically impossible.
Which brings us to the lifeline. The workaround that I am sure saved the sanity of thousands of corporate controllers globally. The modified retrospective approach.
Yes.
Specifically, how it applies to leases that were previously classified as off-balance sheet operating leases under the old standard, as illustrated in illustration 43.
This raises an important question. How do you mandate a massive change in a reporting standard without demanding the impossible task of restating the past?
Right.
The modified retrospective approach is the pragmatic compromise. Under this approach, a lessee does not restate comparative historical figures.
Okay, so they don't rewrite history. If they adopt the new standard in 2024, the published numbers from 2022 and 2023 stay exactly as they were originally reported under the old rules.
That is the core relief it provides. But the standard still requires them to bring all of those old, previously hidden operating leases onto the balance sheet as ROU assets and lease liabilities on day one of applying the new standard.
So they have to bridge the gap somehow. How do they calculate the size of the liability they have to suddenly drop onto their balance sheet?
To do this, they calculate the cumulative effect of initially applying Ind AS 116. On the date of transition for all those old operating leases, they measure a new lease liability. But they don't look backward.
They don't.
No. They calculate the present value of strictly the remaining lease payments, discounted using their incremental borrowing rate on the date of transition.
That is a massive simplification.
Yeah.
If Legacy Corp has a 20-year lease and they are in year 15 when the standard changes, they completely ignore the first 15 years.
They do.
They just stand at the transition date, look at the 5 years remaining, figure out their borrowing rate today, and calculate the liability for just those final 5 years of payments.
Precisely the mechanic. It is forward-looking from the date of transition, and then they must measure the corresponding ROU asset.
How did they do that without going back?
The standard offers a couple of practical expedients here, but the most common is to simply measure the asset at an amount equal to the new lease liability they just calculated, adjusted for any rent they prepaid or any accrued rent they haven't paid yet.
But even with those simplifications, when you are bringing thousands of leases onto the balance sheet for the first time, the new liability you calculate and the new asset you calculate are rarely going to match perfectly.
True.
There is almost certainly going to be a discrepancy. And this leads to the magic trick of the modified retrospective approach. Where does this massive cumulative mathematical gap go if you aren't allowed to go back and restate the past P&L statements?
The key mechanism of the modified approach is that this cumulative adjustment is recognized as a one-time direct adjustment to the opening balance of retained earnings at the date of initial application.
Okay, I need you to explain like I'm 5. Retained earnings for me and the listener, because understanding what retained earnings is makes this accounting maneuver look incredibly clever.
Retained earnings is essentially the company's historical scorecard. It is a component of the equity section on the balance sheet.
Okay, equity.
Think of it as the accumulation of every dollar of profit the company has ever made since the day it was founded, minus any dividends they have paid out to shareholders. It is the company's historical savings account.
So let me translate the brilliance of this. Because the company is not allowed to go back and retroactively lower their profit statements for the last 20 years to account for these leases properly, they calculate the total cumulative mathematical impact of all those missed years. And instead of letting that massive adjustment hit the current year's profit and loss statement, which would make the company look like it lost billions of dollars overnight, they just sweep all that mathematical dust directly into the historical savings account. They reduce retained earnings on day one.
It acts as a necessary shock absorber. By putting the cumulative effect directly into opening retained earnings, the company avoids completely distorting the current year's P&L with a massive one-time transition expense that has nothing to do with their current operations.
That is so smart.
It allows the company to acknowledge the math changed, take the hit to their total equity, and then look purely forward.
Like saying, we took the hit to our historical scorecard, but going forward from today, our P&L represents the new reality. It is a brilliant piece of accounting architecture.
It really is.
But I have to ask, as an investor or an analyst, wouldn't a sudden massive drop in a company's retained earnings freak you out? It lowers the total equity of the company. It can mess with debt covenants.
It absolutely caused anxiety when the standard was first implemented. Analysts had to spend months recalibrating their models.
I bet.
When equity drops, metrics like return on equity ROE can actually artificially spike in subsequent years because the denominator got smaller. Savvy investors had to look closely at the transition disclosures to understand exactly how much of the equity reduction was purely an accounting artifact of Ind AS 116 versus actual operational destruction of value.
It's a reminder that accounting standards don't just measure the game. They sometimes alter the playing field entirely.
That is a very apt summary. The modified retrospective approach is a triumph of practical accounting over theoretical purity. It balances the desperate need for more transparent balance sheets with the practical impossibility of gathering decades of historical lease data.
Okay, we have covered an incredible amount of dense, highly technical ground today. Let's summarize the key takeaways from our journey through Ind AS 116, specifically tailored for the learner prepping for that board meeting or analyzing that next stock purchase.
Sounds good.
First, on modifications. We learned that changes to a lease aren't just minor administrative updates. If a modification doesn't pass the strict two-part test for a separate lease, you are thrust into remeasurement.
And crucially, surrendering space, a decrease in scope, is a trapdoor.
Right, because the straight-line depreciation of the asset rarely matches the curve of the liability reduction. A scope decrease actively hits your profit and loss statement immediately, either generating a phantom gain or a sudden loss.
A critical dynamic to monitor during any corporate restructuring or downsizing announcement.
Second, on subleases. We discovered the core philosophy of the right-of-use asset. You can only lease out what you actually hold.
Yes.
And as an intermediate lessor, you don't hold the physical building, you hold the intangible ROU asset. Therefore, deciding if a sublease is operating or finance must be done by comparing the sublease term strictly to the remaining life of your ROU asset, not the physical property.
Which routinely flips what looks like a simple operating lease into a finance lease.
Forcing the company to recognize a net investment and retain the original debt, permanently altering their perceived leverage.
It forces the balance sheet to reflect the reality of being a financial middleman.
And finally, transitions. We saw how the modified retrospective approach allowed the corporate world to avoid the nightmare of time travel.
By using opening retained earnings as the shock absorber for the cumulative mathematical effect of the new standard.
Right. Companies cleanly adopted the new, stricter rules without restating years of historical financial statements, protecting their current P&L from irrelevant historical adjustments.
A pragmatic bridge between the old world of off-balance sheet financing and the new era of transparency.
I want to take a moment to congratulate you, the learner. We've just spent the last hour dissecting concepts that legitimately give seasoned corporate controllers and auditors pause.
It is not easy material.
Understanding these mechanics, the remeasurement math, the ROU asset philosophy, the retained earnings shock absorber, means you are no longer just passively reading a balance sheet. You know how to read the structural engineering beneath it.
Exactly.
You can now spot when a company's reported profits are being artificially boosted by a lease modification, or how their role in a sublease is silently bloating their debt profile. You have the tools to ask the right questions. You are truly well-informed.
And as we wrap up this deep dive, I want to leave you with a final thought to ponder. A concept to mull over on your own that builds on the fundamental philosophy we've discussed today.
All right, what is it?
In AS 116, as we've exhaustively detailed, hinges entirely on this concept of the right-of-use asset. It is a phantom asset, an intangible right created by a legal contract representing the control over a physical underlying asset like a warehouse, an airplane, or a server rack. But our broader economy is changing rapidly. We are moving aggressively away from physical underlying assets and moving toward digital ecosystems, cloud infrastructure, and entirely virtual spaces. Companies now sign massive multi-year contracts to lease computing power, virtual private networks, and even digital real estate in developing metaverses.
Oh, wow. That is a wild pivot.
So the question becomes, how will these existing accounting frameworks handle the complete dematerialization of assets? How will future iterations of Standard 116 define the economic life of a purely virtual right-of-use asset?
Because it doesn't decay like concrete.
Exactly. If an asset only exists in the cloud, if it is just a dedicated partition of code on a distributed server farm, does its economic life ever truly end? Or does only the contract end?
That's a great point.
How do you calculate the major part of the economic life for an asset that could theoretically be maintained indefinitely? As businesses become increasingly untethered from physical reality, the accounting rules we rely on to tell the story of their economic health will inevitably face another tectonic shift.
That is a deeply fascinating question to end on. The right-of-use asset in a world with no physical limits. It really highlights how accounting isn't static. It has to constantly chase the reality of how business is done.
It certainly does.
Something for all of us to think about as the digital economy continues to eat the physical one. Well, that brings us to the end of our journey today. Thank you so much for joining us on this deep dive into the financial labyrinths of leases. Until next time, keep learning, keep questioning, and keep looking strictly between the lines.